Hi everyone, so we've got some key concept revision here for the level 2 promotion and finance for enterprise exam, and this is for learning aim C of your component 3 stuff here, and this is all about financial planning and forecasting, so let's dive into this. Right, so first up, cash flow is a really important aspect of this learning aim here. So we've just got a little overview as to what's taking place here. You can see money comes into a business. Now money comes into a business through a variety of different methods. The majority of those are going to of course be sales, but also via loans, via share sales and actually selling shares in the business and so on. Okay, when it comes to your paper, it's really going to focus on sales though, as well as loan. Potentially it could be something like rent received if they're renting out a office in the building or something like that. So it could be those sort of varieties of inflows coming in, not necessarily all about profit, okay, because profit is of course revenue minus the costs. And then of course you've got these outflows, and we can see all of those there. Right, so some key concepts. Okay, now you can pause this and just test yourself on these definitions. How well do you actually understand these concepts? Okay, so pause it now before we move on. Right, so of course cash inflows, money entering the business, okay, cash outflows, money leaving the business, of course, and then we've got a variety of examples put down here. Okay, so really important that you understand those different examples, because you could be asked not only for a definition but also to provide an example. Right, okay, so what about these terms here? How well do you understand these terms? Okay, are you able to define these following points? Okay, so you can pause it now and just test yourself. So first up, when it comes to liquid assets, liquidity is all about short-term cash. Okay, so this is of course any short-term assets that you can use to actually conduct purchases. The most liquid asset is of course cash. Okay, cash flow statement, so this has happened in the past. Okay, so this has already happened, whereas the forecast is a forecast. It's going to be in the future. Opening balance is of course how you actually start the trading period. Receipts is the inflows of money into the business, and payments is the outflows of money from the business, of course. So there we go, those terms. Okay, so what about the key calculations? There's two absolutely crucial calculations for the cash flow forecast, and that is net cash flow and the closing bank balance. So just test yourself now. Can you actually identify how to calculate each of those on the cash flow forecast? All right, so pause it now if you want to test yourself. Okay, so first up, this is simply your receipts or your cash inflows minus the cash outflow. So that's it in a nutshell. Cash in minus cash out. That is your net cash flow position. And then we've got your closing bank balance position. Now your closing bank balance, slightly trickier because you've got to factor in your opening balance and then either add or subtract your net cash flow position. And we'll look at a cash flow statement in just a moment. Okay, this is plus or minus depending upon whether the net cash flow position is positive or negative. Okay, right. So when it comes to cash flow forecasting, what are some of the benefits and what are some of the risks of not completing a cash flow forecast? Again, you can just pause the video and just note down any potential answers that you can actually give there. Right, so let's have a look. Okay, various points I've put down here. Identify timings of inflows and outflows. So this means you can actually prepare your finances for a big purchase, say. And it's really important with these points that you're able to explain them just beyond giving one point, because some of the questions for 2 marks, where you've got to actually identify one method and explain it for the second. Likewise, other questions are give 2 ways you could improve the cash flow and explain each of them. So payment dates can be renegotiated if needed. So this would delay the actual cash outflow occurring. So that would, of course, benefit the cash flow perspective. The surplus can be reinvested. So this just means you can actually put that money to work, and you can actually think, right, well, I've got a good old stockpile of cash here. Let's actually invest that money. Okay, so expensive items, you can plan out when you're going to buy those expensive items and buy them at the best time, i.e. when you've got plenty of money, okay? And the business can actually plan its expansion because it knows what its liquidity position looks like. Risks of not completing, may not be enough cash to pay bills or wages, okay? Because you don't know, if you haven't completed any sort of forecast, you don't know where your finances are going to be. Payments may be delayed. So it may be that you've got to actually wait for one of your customers to actually pay you before you can actually make a payment, and so on. So this may delay that payment, and then suppliers will become frustrated, not want to use you, and so on. Okay, all right, good stuff. Now, can you complete the following cash flow forecast? Okay, so again, pause this now and just give this a crack. See if you can just work through the following. Right, so here we are with the answers now, and what we can see here is receipts minus payments, okay, gives us that net cash flow position of 5,000. 5,000 is our net cash flow added onto that opening balance, of course, gives us 7,500. That then becomes the opening balance for the following month. Here we can see we're doing 13 minus 8,500. That gives us 4,500. Add that on, we get that closing balance. That closing balance becomes the next month's opening balance. Here we can see we got 10 minus 12, so that's minus 2, and we end up with 10 grand in the bank account at the end of that month. Okay, great stuff. Right, so what are some of the key reasons why businesses might experience cash flow? Are you able to identify any points? Just have a little think on that, see if you can note down a couple of pointers there. So pause it now. Okay, so some of the reasons for this might be because, of course, they haven't used a cash flow forecast. It may be because they've been over trading, perhaps. Okay, that simply means that they've faced a lot of demand for their products, and they're having to buy loads and loads of stock, but they're not getting paid yet. It may be that debtors may not be pay promptly. So this is your customers who are in debt to you may not be paying promptly. Bills may come in at the same time, and if you're not getting your payments from your customers, that's bad news. It could be about unexpected payments being due as well, okay, and so on. All right, good stuff. So what about methods of solving cash flow problems? Okay, so methods of solving cash flow problems. What can you identify there? How many points can you identify in terms of improving cash flow? All right, so pause the video now and give that a crack. Okay, so some of the key methods, right? If you can reduce your costs, okay, that's going to reduce your outflows. If you can increase your inflows by increasing revenue, selling more products, that's going to be good news. If you can just focus on reducing stock levels, then it means you don't have to buy as much stock, so that's going to help cut your costs again. Delaying payment, can you actually get your creditors to give you a bit more time to actually pay your bills? Perhaps they can offer you 30 days credit or something. Okay, so it could be for your customers, though, you want to only offer 15 days in terms of actually getting paid, okay? So you only offer 15 days credit, but you ask for 30 days credit from your suppliers. So you can also use an early payment bonus. This is where if you pay within a week, say, you offer 5% off. If you've got any unused assets, you can sell them off. Just think about it in terms of a footballer. Okay, perhaps a particularly good footballer isn't actually making the first team. What does that club then actually do? They sell them to another club. That increases the cash flow, of course. What about debt position? So can you actually reduce your debt? Will that help to actually manage your cash flow and so on? And then you can delay big purchases and investments and so on. All right, good stuff. So what about overall points of analysis in relation to the cash flow forecast? Right, so what key points do you really need to focus in on when it comes to the closing balance? What else should we be looking at? So if you get a cash flow forecast or cash flow statement in your exam and it asks you to identify, any problems or what you need to improve about it, what sort of things can we identify here? Well, okay, so just pause it and test yourself there. So, when it comes to the closing balance, if it's negative, they've got to have an overdraft arranged. Now, a small but positive figure allows the business to continue operating, but it's got to be really careful in terms of its cash position. Okay, so a large positive figure may suggest that the business needs to use that money more wisely, okay, because you don't want to just have thousands and thousands of pounds in the bank and not be doing anything with it. That's not good. So what other issues? Is there a month where sales fall? Is there a month where outflows are really nasty? Okay. Is there a particular cash outflow which really hurts the business's cash position? So where they've bought a really expensive new investment or something like that. Okay, so most importantly, I've just said here, be specific and try and use numbers and refer to the exact month as well. And that will strengthen any answer you provide here, okay? All right, so what about break even? Some of the key terms in terms of break even here. So we've got revenue, fixed cost, etc. These points I've given you because you will get these calculations in the exam, okay? So that's the good news for margin of safety and the break even. But can you define those other pointers there? Right, okay, so here's their definitions. So I think that's nice and straightforward. So I'm going to move this through here. Okay, so what about the impact of changing sales, prices and costs on the break-even point? So if sales increase, what will happen to the margin of safety? If sales decrease, what will happen to the margin of safety? And if sales fall below the break-even point, the enterprise will make a... So each of these little statements, you can just have a go at trying to complete each statement there, all right? So just test yourself on that. Right, okay, so here's the answers. So first one, of course, margin of safety increases, margin of safety decreases, etc. Okay, all right, good stuff. Okay, now what about break even? Why is it important? There's a chance you could get like a 6-mark question about it, or it could be a 4-mark question asking you to identify 2 points in relation to any of these areas. So can you actually note down any pointers that you can think about in any of those areas there? Okay, so pause the video, test yourself there. Okay, so these are the sort of points that you may actually want to focus on. Okay, so the business knows the fixed and variable costs, okay, can analyze costs, see if they can be reduced, calculate and forecast revenue, can set a margin of safety, can use what-if analysis to consider impact of price or cost changes. Okay, if you don't complete it, you don't know your break-even, you don't know your margin of safety. And remember, when it comes to the margin of safety, the higher the margin of safety is, the safer the business will be. Okay, now, finally, limitations break even over here. Okay, so it assumes all output is sold, assumes costs remain the same. We know costs and prices rise, don't we? Okay, all right, so what about these terms for our 2 key types of expenditure? Capital expenditure, revenue expenditure. Can you define those terms? Okay, so here's definition, right? Capital expenditure is about long-term expenditure. Basically, this will focus on the balance sheet or the statement of financial position, okay? And it will mean that you'll buy fixed assets. Whereas revenue expenditure, this will focus on your income statement, your statement of comprehensive income, or your profit and loss account. So this is your day-to-day expenditure, so buying stock or inventories, utilities, rent, wages, etc. Okay, so now just finishing off with sources of finance then. Okay, so we've got two key internal sources of finance here: retained profit, sale of assets. Can you define them? Can you say one thing that's good about them? Okay, so first up, retained profits, there's no interest payable, of course. That's the big advantage here. You don't have to worry about any interest as you do with loans, okay? Sale of assets, selling unused assets to improve cash flow. The only downside is, of course, that you don't then have that asset to use in the future. So that's what you've got to bear in mind there. Okay, external source of finance. So this is finance obtained from outside of the business, of course. So what do we got here? We got bank loan, leasing equipment, hire purchase. So just test yourself on those terms. Can you remember what they are? Okay, and then we've got, sorry, almost moved on too quick. Right, okay, so we've got bank loan, so an agreed amount of money that will be paid back over a period of time. So that means that in terms of actually budgeting for it and putting in your cash flow statement, it's really easy to actually see whether you can afford it. Same with leasing, really, and a hire purchase agreement where you buy a machine or a car in installments over time. Okay, so now we've got government grants, we've got venture capital, and we've got peer-to-peer lending. Okay, do these terms mean anything to you? So make a note of them if they do. Pause the video now if you want to test yourself. Okay, and so this is what we've got here: government grants, venture capital, and peer-to-peer. Okay, so when it comes to venture capital, these individuals tend to have real expertise in what they're investing in. So it's almost a little like Dragon's Den. Okay, so they've got expertise. They will invest in that new business, but they will want to take a share of the profits, of course. Okay, so there we go, guys. I hope that's been useful for Learning Aim C. Of course, don't forget to check out the other videos on Learning Aim A and Learning Aim B to make sure you're looking really tip top for this exam.